You ever have to make a huge decision where the future is just a total blank? It can be paralyzing, right? But what if I told you there's a structured way to turn all that uncertainty from a liability into, well, your sharpest strategic tool? Today, we're going to break down a really powerful framework for doing exactly that.
Yeah, we've all been there. Could be a career change, a big investment, or a massive project at work. You're stuck making a choice today that depends on outcomes you can't possibly predict. It feels like you're just navigating through a thick fog. So, how do you find your way?
Okay, so let's get into it. We're going to follow a real-world case about the Pittsburgh Development Corporation, or PDC for short. They were staring down a multi-million-dollar decision with no obvious right answer. And the way they tackled it? It's a perfect roadmap for making smarter choices when the stakes are high. So, here's the setup. PDC has this amazing piece of land, perfect for a luxury condo complex. But they have one central problem, this multi-million-dollar question. To maximize their profit, how big should they build it?
Their choice really boils down to three distinct options. Path 1, build a small 30-unit complex. Safe, but maybe they're leaving money on the table. Path 2, go for the middle with a 60-unit building. Or Path 3, go big, a really ambitious 90-unit high-rise. And as you can imagine, each path carries a totally different level of risk and potential reward.
Now here's where it gets interesting, what PDC can't control. In decision analysis, we call these uncertain future events states of nature. And for PDC, it all comes down to one thing. Will the housing market have strong demand for their condos or weak demand? That is the great unknown. So you've got your choices and your uncertainties. How do you start to make sense of the chaos? Well, this is where our first tool comes in, the payoff table. It's a super simple but incredibly powerful way to map out every single possible future on one grid. And wow, this table really lays out the stakes. Just look at this. If they build the large complex and demand is strong, they're looking at a massive $20 million profit. Awesome. But if they build that same large complex and demand is weak, they're facing a devastating $9 million loss. The small complex, on the other hand, is the safe bet, but the upside is way lower. You can see, every choice here is a gamble.
Another cool way to visualize this is with a decision tree. It's basically a roadmap of the problem. You start at a square, your decision node, where you pick the building size. And from there, the paths lead to a circle, a chance node. That's where the market takes over, and you end up with either strong or weak demand and your final payoff. It's the same info as the table, just shown as a sequence of events.
All right, so seeing all the possibilities laid out is one thing, but how do we actually pick the best one? This is where we shift gears from just mapping the future to actually calculating the smartest bet. And we do that using something called the expected value approach. To pull this off, we need probabilities. Now, based on their expertise in market analysis, PDC's management puts a number on their optimism. They figure there's an 80% chance of strong demand and only a 20% chance of weak demand. This is their starting point, their best educated guess. So we take those probabilities and we calculate the expected value, or EV. A simple way to think about EV is, it's the average outcome you'd expect to get if you could run this same scenario, say, 1,000 times over. It's a weighted average that accounts for both how good an outcome is and how likely it is to actually happen. Let's make this real with the large complex option. It's pretty straightforward. You take that juicy $20 million profit and you weight it by its 80% chance of happening. Then you take that scary negative $9 million loss and you weight it by its 20% chance. Add those two numbers together, and that's your expected value for that decision.
Okay, now for the fun part. When we run that calculation for all three options, a clear winner pops right out. The small complex has an EV of 7.8 million. The medium comes in at 12.2 million. But the large complex, even with that huge risk, has the highest expected value of them all at $14.2 million. So, based on their initial beliefs and the math, the analysis is pointing directly at building the large complex. It has the highest expected payoff. But the story doesn't stop here, not even close. This leads us to a really fascinating question. How much would it be worth to get rid of that uncertainty? I mean, what if you could actually pay for a perfect forecast of the future? We can actually calculate the value of that knowledge. Just imagine you had a crystal ball for a second. If you knew for a fact that demand was going to be strong, of course you'd build the large complex and walk away with $20 million. And if you knew demand was going to be weak, you'd pivot, build the small complex, and make a safe $7 million. You'd always make the perfect choice.
So what's the expected value of that perfect strategy? We just go back to our original probabilities. 80% of the time, you'd know to build large and make 20 million. And 20% of the time, you'd know to build small and make 7 million. The weighted average of that perfect knowledge comes out to $17.4 million.
And here is the bottom line. The best you can expect to make with all the uncertainty is 14.2 million. With a perfect forecast, that number jumps to 17.4 million. The difference between those two numbers, $3.2 million, is the expected value of perfect information, or EVPI. This tells PDC exactly how much gathering more data could be worth. It's a budget. They shouldn't pay more than $3.2 million for any kind of forecast.
Okay. A perfect crystal ball doesn't exist. We all know that. But what about imperfect information? This is where the analysis gets super practical. PDC starts thinking about hiring a firm to do a market research study to get a better, real-world read on what the demand might be. Now, this study will give them one of two results: a favorable report that suggests strong demand, or an unfavorable one. It's not a guarantee, but it is new data. And the key is that this new info allows PDC to update their initial 80-20 belief. For example, a favorable report might bump their confidence in strong demand from 80% to over 90%, giving them a much more refined, data-backed probability to work with.
So now we can calculate the expected value for a whole new strategy. Conduct the study first, and then decide what to build. And when we run all the numbers, factoring in the updated probabilities from both potential study outcomes, a new picture emerges. The original path, just build the large complex, had an EV of 14.2 million. But this new, more informed path has a higher expected value of 15.93 million. The analysis proves it. Paying for the study is the smarter bet.
And this is just brilliant. It reveals the final, optimal strategy. And notice, it's not a single choice. It's a dynamic plan. Step 1, do the market research. Step 2, if the report comes back favorable, you swing for the fences, build the large complex. But step 3, if the report is unfavorable, you adapt. You hedge your bets and build the medium complex instead. It's a strategy that actually responds to new information.
So let's just quickly recap the big lessons here. First, you've got to structure your uncertainty with tools like payoff tables. Second, you can use expected value to find your best bet based on probabilities. Third, you can actually calculate the value of getting more information before you decide to pay for it. And finally, and this is so important, remember that the best strategy is often a flexible plan that can adapt as you learn more.
This whole framework took a massive, multi-million-dollar gamble and turned it into a logical, data-driven process. It replaced a pure gut feeling with a real strategic plan. So, the question I want to leave you with is this. Now that you have these tools, what's a big, uncertain decision in your own life or work that you could start to analyze with a bit more clarity?